everyone, this is Vaishali Siddhappa and welcome to my channel Complementary Economics, and today's topic balance of payment from Open Economy chapter. The question comes like, write a note on balance of payment. This is one of the 6-mark questions this year. When it comes to balance of payment, previous videos of mine, it was about the current account and a capital account chart that is completely related to BOP. That's both are part of BOP. What is BOP is? BOP is nothing but balance of payment. So today's topic. So what is BOP actually? Whatever the transaction we are doing between the countries, out of the countries, whatever the transaction it can be about the goods, it can be about services, it can be about the assets. Whatever the goods, services, assets you are doing any kind of a transaction with any other countries, that will be maintained a record. It's a complete record of the transaction what you're doing with other countries for one time duration. The one time duration, it can be for 1 year. Within a 1 year, whatever the transaction you're doing with any of the country, any kind of a transaction, that will be recorded. That's called balance of payment. So the balance of payment classified into 3 different ways. One is a current account, the second one is a capital account, and the third one is financial account. Right now, your syllabus excluded the financial account. The simple reason behind it is, this is a new classification in which the balance of payment have been divided into 3 accounts: the current account, financial account, capital account. This is as per the new accounting standards specified by the International Monetary Fund, the IMF. In the 6th edition of Balance of Payment, an International Investment Position Manual, which is called as BPM6. India has also made a change, but the Reserve Bank of India continues to publish data accounting to the old classification only. That's the reason why we excluded the financial account. Still, we are going with the current account and the capital account. And the next, let's talk about the first classification. The first classification is current account. What is the current account? The current account, we're going to maintain record for goods, services and transfer payments. So now you can see the current account components. In this you can see first one, trade in goods, trade in services, transfer payments, goods, services and payments, transfer payments. The trade in goods, it comes with exports and imports that I'm going to talk later in the next slide. Trade in services, when it comes to net factor income, that means for the land, labor, capital, organization, how we are paying, what is the transaction we are doing for the factors of production, that is recorded in net factor income. And the next one is net non-factor income. In this we have about shipping, banking, insurance, tourism, software services, these all. On the other side, we have transfer payments. What is the meaning of transfer payments? Transfer payments, even it is called as one-sided transaction. One-sided transaction, in that case, if I am giving you any kind of a gift, so the same gift, no need to return back. So that is for you. You can use it whenever you feel like. For an example, one more example, I'm going to adore you so much that I'm going to give you some financial help. Whenever I find you are in a difficult time, I'm going to help you out by giving some financial help. But I'm just giving you because you're my friend. No need to give it back. These kind of one-sided transaction, I'm giving you, but you're not returning that. That is for you. So that kind of a transaction, it is called transfer payments. It all comes under gifts, remittance and the grants. And next thing, here we're going to talk about exports and imports, complete picture of it. I just told you in the last slide, I'm going to talk later, the next slide. What is export here? The exports means whatever goods and services you have, you're going to sell that to some other countries in abroad. Whenever you're going to sell any of the goods and services, for that you're going to get income. That income will be added in the aggregate demand. On the other side, you have imports. What does the import means? The import means you're going to purchase any other country's goods and services. That will be called as an import. Whenever you're going to do import, that means you're going to spend your money. So the spending money for other countries' goods and services, that's called as an expenditure. For us, it is an expenditure. For some other country who is selling that, for them, it is an income. So this way, whenever you're going to purchase any other country's goods and services, the demand for your country's good, domestic demand for goods, it is going to decrease. Now, let's talk about what is deficit, surplus and balance. The third kind of this is called balanced current account. Deficit current account and surplus current account. Let's talk about the first one, which is deficit current account. So here you can see here the first one, imports, it is down. So that means the weightage of it is more. Can you see the weight? It is coming down because of the weight. So that means imports are greater than the export. The exports are light. That is the reason why it is in the high. So don't consider this is a high and less. This the weightage is more. That's the reason why it is coming less. So in this case, imports are greater than the exports. If the imports are greater than the exports, that means for the country, expenditure is greater than the income. The expenditure is greater than the income, that's called deficit. If I'm spending money for 100 rupees, I'm getting income for only 60 rupees, the 40 rupees of shortage I have, that shortage is called deficit. So whenever we prepare any current account, when we maintain a record, if we see that imports are greater than the exports, expenditure is greater than the income, so that will be called as deficit current account. On the other side, you have surplus current account. In this case, you can see the exports are greater and imports are lesser than that. That what it is trying to explain is, if the country's income, if it is for 100 rupees, if the expenditure of the country, it is for 60 rupees, the money which is left in the economy, that is 40 rupees plus 40, and this is the minus 40. So whenever you're going to save extra 40 rupees, so that is a surplus for the country. So then any record, when you're going to maintain a current account, if you have more income than the expenditure, that will be called as surplus current account. And the last one, you have balanced current account, where exports are completely equal to imports. That means if exports are for 100 rupees, imports is also 100 rupees. If the expenditure is 100 rupees, income is also 100 rupees. They both are equal to each other. That is called balanced current account. So what we have got to know is which is favorable for the country. So when it comes to favorable, balanced current account is also favorable for the country. At the same time, surplus current account also favorable. Deficit current account, that means you have a shortage of money, you're going to spend more than the income, so that is not beneficial for any country. So we say that this is a disadvantage, otherwise unfavorable. This is called advantage, favorable trade. So the next one here we're going to talk about, the balance on current account has two components, that is BOT and balance on invisible. What is BOT here? The balance of trade. BOT means balance of trade. In the balance of trade, we're going to maintain a record of only goods, not the services, only goods. Whatever the goods you're trading, the goods means which is visible merchandise items, what we have, the only that record will be maintained. That record will be maintained for 1 year of time duration. That is called BOT, which is balance of trade. So balance of trade, also we have deficit balance of trade and balance of trade and surplus balance of trade. Exactly like a previous slide what we have studied, deficit, that means imports are greater than the exports. On the next one, balanced trade. In the balanced BOT, so what we see is exports and the imports, they both are equal. In the surplus BT, so surplus balance of trade, so in this case exports are greater than the imports. So this will be called surplus balance of trade. So this way again the BOT can be classified into deficit, balanced and surplus. I'm not going to explain this much brief because just in the last slide I've explained what is the meaning of deficit, what is the meaning of balance, what is the meaning of surplus. If you see exact last video, if you understand exactly the same situation here also. There we are counting goods and services both, but here we are going to count only the goods. The next one, the balance of the current account, again it will be the second classification will be balance on visibles. The goods which is invisible, in that we are going to add services and transfer payments. I have already explained what is service and transfers. Next here you have the capital account, which is balance of payment can be classified into current account and the capital account. Current account we have already studied now. So now you have the capital account. What is the capital account? It's a complete record of all international transaction. It can be about the assets, it can be about the stocks, bonds, money, any kind of a government debt, whatever the things financially transferring to some other country, any transaction between the countries financially, that will be recorded. That record is called as capital account. So this is the component, again the components of capital account. So there are three different ways. One is the investment, the second one is the external borrowings, the third one is the external assistance. So we've already done with this. Investment you have about FDI, equity capital, reinvested earnings, FII, which is a foreign institutional invest, offshore funds. When it comes to external borrowing, it is external commercial borrowing, short term debt. External assistance, it comes like government aid, intergovernment and multilateral and bilateral loans. These all comes under capital account. These are the things which we are going to maintain a record of. So when we are going to maintain record of these all stuffs, so here also again we talk about deficit, balanced and the surplus. Deficit capital account, balanced capital account, surplus capital account. Again it is the same thing. Deficit means the inflow. The deficit means the inflow of money is more than the outflow of money. So balanced one, inflow and the outflow both are same. Surplus, outflow is more than the inflow. So this way if you are going to maintain a record, that will be called as capital account. So I hope you completely understood what is BOP and the components of it, current account and the capital account. Current account, again you have two different classification, that is BOT and the balance of invisibles. So we have already discussed everything. I hope you understood completely. This is one of the 6 mark, and again in the next topic I am going to talk about BOT. So both together if you read, you will understand better. Thank you so much. Please subscribe and share. Thank you.